Hi, I'm Paul Mensinger with CPMI Professional Development, and we've developed a method which allows a prospective agent the opportunity to bring the insurance licensing seminar right into their home or the office of their general agent anytime they want it. We've taken the classroom seminar with which we've helped hundreds of people pass the insurance licensing exam and put it in video format. Let's look at some clips from the video seminar. Not all risks are insurable. Insurers look only to insure pure risks in which there is a chance of loss but not the certainty of a loss. Speculative risks where there is a chance for either loss or gain, or certain risks, are generally not insurable. Conditions which must be met for a risk to be considered a pure or insurable risk include that the loss be due to chance, that it be measurable, that it be predictable, and that it be based on a large enough pool of individuals so that the law of large numbers can allow the insurer to accurately predict losses, and that the risk is selected from a diverse, randomly selected pool of insurable risks. Now let's look at types of health insurance policies. The term health insurance refers to a broad scope of insurance plans which provide financial protection for losses suffered due to illness, accidents, disability, or other physical injury. The three main categories of health insurance include disability income insurance, accidental death and dismemberment insurance, and medical expense insurance. The first of these we'll look at is disability income insurance.
People often think of the need for medical insurance for doctor or hospital bills, or for life insurance to cover the total loss of income due to premature death, but what about the loss of wages due to periods of disability? Also called loss of income insurance, disability income insurance pays up to a maximum of about 60% of income lost as the result of disability. This is one of the most frequently overlooked exposures, and at most ages, the probability of a serious long-term disability is greater than that of death.
Per stirpes and per capita are legal terms specifying how benefits will be distributed to a person's descendants. Per stirpes refers to by branches, and any proceeds designated to a particular named beneficiary on a per stirpes basis will be passed on in equal shares to that beneficiary's children if the beneficiary died before the insured. If the beneficiaries are named on a per capita basis, however, policy proceeds would go only to those beneficiaries named directly in the policy. For example, Bob and Jane are two children named as beneficiaries per stirpes in their father's insurance policy, and Bob has two children of his own. If Bob dies before his father, then when the father finally dies, Jane will receive her half of the death benefit, and Bob's two children will receive equal shares of Bob's half of the death benefit. If Bob and Jane were named as beneficiaries on a per capita basis, Jane would receive the full death benefit if Bob died before his father.
Endowment, cash from life insurance payable to the policyholder at maturity of the policy, usually the insured's age 100, if the policyholder is still alive. And final expenses are the financial costs related to dying, typically funeral, medical expenses, debts, taxes, and administrative expenses.
This is the end of Section 1 of this. Buy-sell agreements. A buy-sell agreement is an arrangement entered into between partners or associates wherein surviving members agree to purchase the ownership interest in the company from the deceased owner's estate at a predetermined price. Such an agreement is only of value if there is adequate funding for the predetermined price. This is where life insurance becomes a valuable asset. Do any of us have friends that we like dearly but we can't stand their spouse or children? Think of the business partners who have been friends and partners for many years but don't get along with each other's spouses. If one of the partners dies, guess who the new partner is? Partly to help avoid this type of situation, buy-sell agreements are extremely important. The mechanics of the agreement are that each partner or shareholder purchases a life insurance policy on the life of each of the other owners. Each partner also enters an agreement to purchase the other's ownership interest in the event of death. While life insurance can provide the funding, it can quickly be observed that a lawyer will be necessary to draw up the actual agreement binding the owners contractually to carry out the purchase upon the death of the other. Thank you for your interest. We hope you'll let CPMI Professional Development help you learn what you need to know to pass the State Insurance Producer License exam the first time you take it.